Warren Buffett gives away all his investing secrets for free every year in Omaha, but here's what shocked me. 99% of the people missed the most powerful advice buried in his offhand comments. Most investors think Buffett's success comes from picking great stocks and holding them forever. Well, that's what everyone tells you. Buy quality companies, hold long term, and you'll get rich. But after analyzing hundreds of hours of Buffett's interviews, shareholder meetings, and lectures, I've discovered something that completely changed how I think about wealth building. Buffett's real secret isn't what he buys, it's how he thinks. He's architected a systematic approach to hacking human psychology and the market emotions that has nothing to do with stock picking. This hidden framework has created more millionaires than any other investment philosophy in history, and I'm about to break down every piece of it. By the way, I'm Gary Gill. I've helped thousands of people build wealth through my content, and what I'm about to show you will fundamentally change how you approach money forever. All right, here is Buffett's secret framework that most people completely miss. First, Buffett has a literal test he performs before buying any stock that most investors have never heard of. He said, "I never buy anything unless I can fill out on a piece of paper my reasons for buying it, my expectations for the company, and I must be able to explain the business model to a 10-year-old in under 2 minutes. If I can't do that, I don't invest." But here's the part that blew my mind. This isn't about understanding the business, it's about understanding the economics of the business. He once said, "I could improve the operations of almost any company in America." But that's not the question. The question is, can I improve the economics? Watch this principle in action from a 1994 interview that changed everything for me. Buffett said, "Give me any business model, and if I can understand how they make money, who their competitors are, what their competitive advantages are, and most importantly, whether those advantages are widening or shrinking, I can tell you if it's worth investing in." But this gets even more interesting. Buffett revealed in a 1996 shareholder meeting that he has a secret framework that he calls the 4 filters, something he developed back when he was managing just $105,000 for doctors and farmers in Omaha. Filter 1 was, can I understand it? If you can't explain how the company makes money in one sentence, it fails. This came from his early mistakes buying Berkshire Hathaway, a failing textile company, simply because it was cheap. Filter 2, does it have favorable long-term prospects? Will people still need the product in 20 years? Filter 3, is management honest and competent? Do they treat shareholders like partners or ATM machines? And filter 4, is the price attractive? Even the best businesses is a bad investment at the wrong price. And here's a genius part that nobody talks about. Buffett doesn't try to expand his circle of competence by studying new industries. Instead, he waits for great businesses within his circle to go on sale. As he put it, "I'd rather buy a wonderful company at a fair price than a fair company at a wonderful price." This wisdom came from years of learning. He spent his 20s buying cheap, mediocre businesses before realizing that owning pieces of exceptional companies was the real path to wealth. Here's where Buffett's approach gets really revolutionary, and it's completely changed how I think about valuation. Everyone knows his famous quote, "Price is what you pay, value is what you get." But what he actually means by this intrinsic value will shock you. Buffett doesn't use complex models or fancy formulas. In a 1992 interview, he revealed his actual method. "I asked myself a simple question. If I could buy this entire business today for the market cap and I had to hold it for 10 years with no ability to sell, would I be happy with my returns?" It's like asking yourself whether you'd buy a rental property if you knew you couldn't sell it for a decade. You'd focus purely on the cash flow it could generate. Buffett calculates intrinsic value by estimating how much cash the business will generate over its lifetime, then mentally discounts that back to today using the 10-year treasury rate. That's it. No spreadsheets, no fancy models, but here's the real secret sauce that creates fortunes. Buffett revealed in a 1987 Fortune interview that he only invests when he can buy a dollar for 50 cents. "I need such a large margin of safety that even when I'm wrong about the business, I still make money." In 1973, he bought Washington Post stock for $10 million when the company was earning $13.3 million per year and had assets worth $400 million. But the market valued it at only $80 million. Buffett said it was like buying a $400,000 house for $80,000. That was also generating $13,000 in annual rental income. You have to be crazy not to buy it. But what nobody tells you about Buffett's approach is that he's actually terrible at timing. He's been early on most of his biggest wins. The difference is what he explained. We never try to time the market. We try to time prices. Market timing is like trying to predict the weather next month, but price timing is like waiting for your favorite restaurant to have a half price sale. This brings us to what might be the most important principle that separates Buffett from every other investor, and that is pure psychology. Everyone knows be fearful when others are greedy and be greedy when others are fearful, but Buffett has a systemic approach to what he calls emotional arbitrage, profiting from other people's emotional mistakes. During a 1987 Black Monday crash, when the Dow dropped 22% in a single day, Buffett was buying stocks hand over fist. He said, "I can calculate the motions of heavenly bodies, but not the madness of people. And that madness is what creates opportunity." Here's his secret framework for emotional arbitrage that most people have never heard of. Level 1, optimism. Everyone is bullish, valuations are high, Buffett sells. Level 2, excitement. People are getting euphoric, Buffett stops buying entirely. And level 3, euphoria. Market peaks, Buffett sits on cash waiting. Level 4, anxiety. First signs of trouble, Buffett starts getting interested. Level 5, fear. Market declining, Buffett starts buying slowly. Level 6, panic. Market crashing, Buffett backs up the truck. It's like being at an auction. Everyone bids with their emotions while you bid with cold, hard logic. During the 2008 financial crisis, when everyone was running for the exits, Buffett invested $5 billion in Goldman Sachs and $3 billion in GE. Both investments made billions in profits because he had trained himself to feel excitement when stock prices fall. As he puts it, falling prices are like a Weight Watcher getting excited about a declining scale reading. But here's where Buffett's genius transcends investing and enters pure wealth psychology. And this completely changed my perspective on money. Buffett doesn't just understand compound interest, he's architected his entire life around maximizing it. In a 1985 Columbia lecture, he revealed something incredible. The most important thing in investing isn't how much you make, it's how much you don't lose. Every dollar you lose costs you exponentially more than a dollar you gain helps you. Here's the math that will shock you. If you lose 50% of your money, you need a 100% gain just to break even. But if you compound at 15% annually without any major losses, you'll multiply your money by 16 times in 20 years. This is why his rules are so simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. But here's the kicker that proves this philosophy works. Buffett revealed in a 1988 interview that his best returns came not from his best stock picks, but from his longest holdings. Time is the friend of the wonderful business and the enemy of the mediocre one. He bought Coca-Cola stock in 1988 for $1.3 billion. Today, Berkshire Hathaway receives over $700 million annually in dividends alone from that investment, meaning the dividend yield on his original investment is now 50% per year. It's like planting an apple tree that not only grows bigger every year, but produces more apples than you paid for the entire orchard. The most shocking statistic, 99% of Buffett's wealth was created after the age of 50 and 95% after the age of 65. That's the power of letting compound interest run for decades. Now here's where Buffett's advice gets controversial and most financial advisors will hate what I'm about to tell you. Traditional advice says diversify across 20 or 30 stocks. Buffett calls this protection against ignorance. In a 1993 interview, he dropped this bombshell. Diversification is protection against ignorance. It makes little sense if you know what you're doing. I have 5 stocks that represent 75% of my net worth, and I sleep like a baby. But Buffett doesn't just concentrate. He concentrates intelligently using what he calls the pyramid strategy. Tier 1 gets 40 to 50%, your highest conviction idea. Tier 2 gets 20 to 25%, your second best idea. Tier 3 gets 15 to 20%, your third best idea. And Tier 4 gets 10 to 15% diversification holdings. Here's what blew my mind. Buffett revealed that 90% of his wealth comes from just 10 stock picks over 60 years. I'd rather own pieces of 10 wonderful businesses than pieces of 50 mediocre ones. This philosophy evolved from his early days when he was diversified across dozens of small positions. He learned that concentration on his best ideas rather than spreading money across many mediocre ones was the path to extraordinary returns. But for smaller investors starting out, Buffett suggests something different. With 10% of cash in short-term government bonds and 90% in very low-cost S&P 500 index fund, I believe the trust's long-term results from this policy will be superior to those attained by most investors. Interesting, this is similar to how he started broadly learning about markets and businesses before developing the expertise to concentrate. Why the difference? Because until you develop true expertise in analyzing businesses, concentration is dangerous. Only when you can honestly say that you understand a business better than most people should you concentrate your investments. But here's something that completely changed my understanding of Buffett's success. And it's not just about stock picking, it's about how he structured Berkshire Hathaway as the ultimate investment vehicle. In a 2007 interview, Buffett revealed the secret. Berkshire has permanent capital. We never have to sell stocks to meet redemptions like mutual funds do. This means we can buy when others are forced to sell and hold forever when others are forced to sell. This structure gives Buffett superpowers that regular investors don't have. While others face margin calls and quarterly pressure, Buffett can buy during crashes, hold for decades without pressure, make concentrated bets without worrying about volatility, and access special deals others can't get. During the 2008 crisis, he got Goldman Sachs preferred stock with 10% annual dividends plus warrants, Bank of America preferred with 6% dividends plus warrants, worth billions, and General Electric preferred with 10% dividends plus warrants. It's like being the only customer with VIP room access where all the best deals are kept. But here's the most important lesson that separates Buffett from every other investor: his obsession with continuous learning. Buffett doesn't just read financial statements, he reads 500 plus pages per day. In a 1991 interview, he revealed his actual learning system. I read everything. Annual reports, trade magazines, newspapers, books about businesses I'll never invest in. The goal isn't to find the next investment, it's to build a database that compounds over time. His daily routine: 6:30 a.m., read 5 to 6 newspapers cover to cover. 8 a.m., start reading annual reports and business publications. 10 a.m., make investment decisions based on accumulated knowledge. Rest of the day, more reading with breaks for meetings. He said that's how knowledge works. It builds up like compound interest. All of you can do it, but I guarantee not many of you will do it. Buffett estimates he's read over 100,000 annual reports in his lifetime. It's like being a master chef who studies every cuisine in the world, even if you never cook Italian food. Understanding how pasta works makes you better at everything else. After analyzing hundreds of hours of Buffett's content, here's what actually separates him from every other investor. He thinks in decades, not quarters. He focuses on business quality over stock price movements. He's infinite patience to wait for great opportunities, and he's built a learning system that compounds knowledge over time. He structured his investment vehicle for maximum flexibility, and he understands that psychology drives markets more than fundamentals. He concentrates on his best ideas rather than diversifying into mediocrity. But here's most important insight. Buffett's success isn't about being smart, it's about being rational in an irrational world. Success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges that get other people into trouble. This temperament was forged over decades. From that 11-year-old boy buying his first stock with money from his paper route to creating one of history's most successful investment vehicles. The main takeaway: start building your investment knowledge like compound interest. Read annual reports, study businesses, understand economics, wait for great opportunities. And most importantly, think like you're buying pieces of a business, not lottery tickets. This is the same path that transformed a newspaper delivery boy from Omaha into the world's most successful investor. Remember, as Warren Buffett says, someone's sitting in the shade today because someone planted a tree a long time ago. Warren planted his first investment tree at the age of 11 with $114.75 from his paper route. The question is, when will you start planting yours? All right, watch these 2 videos for more investing tips. Bye guys.